Thanks, Andreas, and thanks everyone for giving us the opportunity to dig a little deeper into the Pimco platform and the opportunities that we see at Pimco working alongside Allianz. So getting into it, since 2021, where we've been at Pimco has been initially through a pretty difficult period. We had, as we all know here, in 2022, the worst or one of the worst years for bonds ever, because of course, everything that we know in terms of the war, the inflation that came on, and the higher interest rates that came from there. Since then, there's really been a stabilization, and there's been a return to growth this year. You saw some of those numbers from Andreas, and we believe that that growth is sustainable out over the next many years, driven in part by this high yield environment, the yields in fixed income far above where they'd been over the last 15 years or so, presenting an investment opportunity that is truly compelling to our clients in the context of an under-penetration of fixed income in portfolios. And we'll talk a little bit about that. Also, demand for alternatives, especially demand in more diversified private lending opportunities, where Pimco is a leader across asset-based finance, a key area of growth for us. And then growth in wealth and retirement, many of the themes that Andreas and Oliver talked about very clearly at play at Pimco and in fixed income. All of this we want to be diversified, and we have built out a diversified business that we see continuing to become even more diversified. First of all, in terms of third-party assets, 1.8 trillion euros in total. 350 of that is Allianz assets that Pimco manages. The rest is third-party. Then diversification across client type, across asset class, across region. We show the numbers here. Some important things to call out. Over the last several years, there's been a lot of growth in wealth, now by revenues, and you'll hear us talking a lot about revenues as opposed to AUM. We think in revenue terms more often than AUM terms. In revenue terms now, the business is balanced, 50-50 between institutional and retail. Institutional remains more than 50% of AUM, but it's now balanced in revenues across the two. By asset class, a lot of new diversification there as well, and we seek to continue that diversification. Alternatives now 23% of the revenues of the business, a significant driver of growth. Also, more diversification across the traditional public fixed income side of the Pimco business, especially the income complex, which we'll speak a little bit more about. Then by region diversification as well. APAC, a very strong high-growth region for us. The Middle East, another strong high-growth region for us. Within the Americas, U.S. institutional is a pretty mature market now, but wealth is growing as well. So diversification across the board there. Pimco continues to focus and to provide to our clients, whether it's Allianz as our largest clients or all of the clients around the world, investment outperformance. We'll talk a little bit about how we get there, but our portfolio managers, our team strives to deliver best-in-class outperformance, and these numbers show that we have delivered. Over the last 5 years, 84% of our AUM is performing above benchmark after fees. 81% of it is performing above our competitors after fees. And that's just on the traditional public fixed income side. If we look at the diversified private credit offerings that Pimco provides, these are higher quality asset-based finance type of opportunities, specialty finance, residential mortgages, real estate lending, corporates. There, the loss ratios have been very low, providing an up in quality opportunity set to our clients. Now, we have sought to, and we continue to provide resilience in our business. And one of the things that we're most proud of over the last few years, in a very difficult time and challenging time for our clients and for our business in fixed income, has been the stability in revenues. And you see here in this chart, this stability in revenues, even in 2022 and 2023, when the markets were very challenging for the business. How did we do it? Well, we grabbed some market share from our competitors. Best-in-class client servicing, best-in-class investment outperformance, especially in terms of risk versus return, as Oliver spoke about. We were able to gain market share in an already advanced market share position to help to offset some of the loss of AUM and loss of revenues, and also performance fees. That diversification of the business across hedge funds and some of the alternatives that provide those performance fees helped to offset some of the loss of revenues. Now this year, bonds are back. Bonds are back, yields are stabilizing, even coming down somewhat in some parts of the world, and we're starting to see that growth materialize as clients become more and more comfortable with this stabilization in fixed income markets. Not only has the top line been resilient, but the margin has been resilient too, resilient and well above the competition. So we have been looking to contain or to maintain a 40% operating margin over the last several years, and we have been there working alongside Allianz. Andreas spoke a little bit about it and how we're there. A ruthless focus on efficiency and the ability to provide best-in-class solutions to our clients in the context of an efficient platform has provided these margins far in excess above our competition. Now, one of the really exciting stories that has emerged in recent years is a closer and closer collaboration with Allianz. So for the longest time, Allianz has been our most important client, our largest client, 350 billion of assets under management. And that, of course, is quite important. And Pimco has to fight every day to earn that AUM. But over the last few years, as Andreas mentioned, there have been more and more examples of this convergence between insurance and asset management. That is such an exciting development in the whole industry of asset management, where Pimco is specially placed to be able to work with Allianz on solutions to take advantage of growth in the insurance liabilities and have that deliver growth in assets under management. And it's not just about driving top-line AUM growth, but especially about finding ways to seed high-priority new initiatives, especially in alternatives. And Allianz has been absolutely critical for us in being able to provide balance sheet and seed AUM to launch new products. Our clients, our LPs, when they see Pimco launch a new product, they want to see that Allianz has skin in the game. They want to see that the house is involved. And Allianz has been there for us to drive that growth. And the Sconset Re platform that was just announced by Andreas is a key part of those initiatives where we see further growth there, driving further launches of new alternatives products at Pimco. So thinking about short and long-term growth opportunities, for right now, there's an enormous growth opportunity just in core traditional fixed income, especially in the income complex at Pimco. The income fund, whether it's the US or the international version, you put it together, it's the largest mutual fixed income actively managed mutual fund in the world. It is the fastest selling fixed income actively managed mutual fund in the world, managed by Dan Ivison and Alfred Murata. It is one of the most compelling offerings that we have to our clients, a little bit shorter duration than some of the other products that have dominated Pimco's business over the years. And that has given a lot of clients comfort in getting back into fixed income after the volatility that we've seen. But also asset-based lending. Asset-based lending is a natural extension of the Pimco platform. All of the things that we've done for years and years in securitized credit are becoming outside of the banking system opportunities in this asset-managed business in asset-based finance. So those will be the short and then the long-term opportunities. But for right now, there is an amazing opportunity to deepen fixed income penetration in portfolios. This chart is a very simple portfolio optimization. So if in 2021 you had rates of near zero, well, then you probably only would have had your portfolio at about 15% in fixed income. Fast forward to today, with rates much higher, Oliver mentioned 2% real rates in the US. It's incredible, 2% real rates in the US. Net of inflation, you're getting 2% for US Treasury exposures. This is phenomenally much higher than we've seen in the last 15 years. And so given those levels of yields, The optimal portfolio is really more like 50% in fixed income. And very few of our clients' portfolios are structured this way. There is significant room for deepening of penetration of fixed income in portfolios, and Pimco is leading the way in capturing those flows. And we see here in this chart that Pimco is the #1 recipient of these net flows into fixed income that we're seeing this year. Why is this opportunity so great? Why doesn't it just go to passive? Because still the vast majority of what Pimco does is active fixed income management. Well, many of the people here are equities analysts, and so I am a credit analyst by training, and I get it. It's difficult. Your job is very difficult. But the reality is that fixed income markets, it's just easier to deliver alpha. There are more than 30,000 securities in the Barclays Global Ag Index. In the S&P 500, of course, there are 500. There's much more room for there to be mispricings. There's much more room for there to be opportunities to capture in fixed income because of the complexity of fixed income that remains. Liquidity is better and better in fixed income in recent years because of the advent of the all-to-all platforms where Pimco is a leading innovator, and Mohit Mittal, our CIO for traditional strategies, has written about this in recent months, about the improving liquidity in fixed income markets. But despite that improving liquidity in fixed income markets, which is an important offering to our clients, they want to know that there is liquidity still in fixed income, and in fact improving liquidity. Despite that improving liquidity, there still is ample room for alpha. And sure enough, Pimco funds, 79% of Pimco funds outperforming the benchmark, and with 70 basis points of outperformance relative to the benchmark, far above our competition. And so that investment performance will help to drive growth. Meanwhile, alternatives. Alternatives has been a phenomenal source of growth for us in recent years, in part spurred by a partnership with Allianz in 2016, about 75 billion of alternatives assets under management. Today, 170 billion, and well diversified across real estate, multi-asset credit, hedge funds, asset-based finance, which I mentioned, but which is growing like a weed, and then corporate credit. So not just a lot of growth, but diversification of that growth. And the way that we're growing it is by going out to clients and presenting the platform, presenting alternatives as a natural extension of the scaled platform of Pimco. All of the portfolio managers around the world, with all of their connectivity to so many counterparties, whether they be banks, which are a minority now of origination volumes, or financial advisors, or private equity sponsors, or direct originations with corporates, or our platforms. We have platforms that sit inside of Pimco funds. We have minority stakes in platforms where we're helping to take some of their origination. We have offtake agreements with originators. We have opportunistic. The platforms are a diversified source of origination that gives us an edge relative to much of our competition, especially in that diversified private lending, private alternatives area. Turning, though, to risk management. Risk management is embedded in everything that we do at Pimco, clearly in our investment management, and that shows in how we've outperformed in times of volatility, but also it's embedded in the way that we run the business, the way that we service our clients, the way that we develop our products, and our commitment is to continue to be laser focused on risk management. Another natural question you would have is, well, how can you maintain these margins when there is so much pressure on costs in this business? And one ingredient right now is AI. Pimco has been an early adopter of AI tools. We've developed a number of tools internally, which we've been rolling out. They are phenomenal in the amount of efficiency that we can gain from them. There's a lot more to come in this space, but it is an area of significant focus for us. Now, finally, just to wrap things up, we will remain focused on excellence, excellence in client service, excellence in investment performance. The size and scale will matter, and we will leverage that size and that scale. We will focus on business resilience and on smart growth. And some key ambitions that we have would be double-digit growth rates across wealth. So wealth will be a very important driver for us over time. 30% of revenues to come from alternatives. This is an area, as I've discussed, where we believe that we have a key edge, particularly in asset-based finance, which is the new wave of growth in alternatives. We believe that we can maintain double-digit growth rates in key global markets, so that would be things like APAC, the Middle East, a few other markets. In mature markets, things are stable, but we want to remain stable there, but build on our incumbent position, gain some market share where possible, and diversify revenues, especially by the alts channel. And then finally, defend those industry-leading levels of profitability. And so with that, I'll say thank you, and I will hand it off to the one you've been waiting for, is Claire Marie.